Today we're talking about DTI, or your debt to income ratio. Now, what I'm about to cover with y'all is basically Cliff Notes, and it gives you a simple way to kind of do a self-calculation or a self-estimate when it comes to your DTI. Obviously, if you want to determine your actual qualifiers, give me a call and we can come up with your actual precise numbers. This is going to be a quick way to kind of ballpark your figures and hopefully give you an idea of how these things work. So your DTI, or your debt to income ratio, is probably one of the top 3 things that can cause issues and kind of make or break a file when it comes to qualifying, pricing, etc. I would say top 3 would be, in no particular order, but probably this particular order: your credit, your DTI or debt to income ratio, and your assets, right? So this is the big one, and I just want to kind of show y'all real quickly how we come up with these numbers. Now, contrary to popular belief, your debt to income ratio is not calculated by your total lump sum debts divided by your income. A lot of people don't realize that your debt to income ratio is actually taken and calculated by using your monthly debt. So we take your total monthly payments of everything on your credit report, and in some cases some things that aren't showing on your credit report, and we divide that by your monthly qualifying income. You have 2 different types of DTI that are analyzed in most files. Your first is going to be called your front end, or your housing expense ratio. Your housing expense ratio basically consists of your principal, your interest, your taxes, your insurance, your mortgage insurance if applicable, and any homeowners association dues. That would come to your total estimated monthly payment or housing expense. We would divide that by your monthly qualifying income to come up with your housing expense ratio, right? So let's just say, for example, that you have a $2,300 housing expense. That's your principal, interest, taxes, insurance, MI if applicable, and your homeowner association dues. All of it $2,300, right? Your qualifying income is $7,700 a month. We take that $2,300, divide it by the $7,700, and we come up with a 30% housing expense ratio, right? Your back end debt to income ratio is essentially all of your debts divided by your qualifying income. All of your monthly debts divided by your monthly qualifying income, right? So let's say, with that same example, your total monthly debt is $3,500. We've got the $7,700 in qualifying monthly income. That would mean that your back end DTI, or debt to income ratio, is 45%, okay? Moving on, because now that we know how we calculate these numbers, I want to quickly talk about some things that you might be calculating in those equations that we might actually be able to omit, okay? Meaning we may not have to count that against you. Now, some things that most lenders are going to omit on most loans are going to be your medical expenses, or medical collections rather. In some cases, installment debts that have less than 10 payments remaining. So an installment debt is kind of the opposite of a revolving debt, right? So typically it would be like an automobile loan that you're financing, not that you are leasing. So a finance vehicle, let's say you have a 50-month term on that, and you've got 40 months paid, so you've got 10 months remaining. In many cases, we can omit that payment from the DTI calculation, right? Now, as you may have caught there, I specified that that's only for a financed vehicle and not a vehicle that's going to be leased, because most underwriters are going to look at a leased vehicle and they're going to say, okay, well, yeah, they've got less than 10 payments remaining, but what are they going to drive once this is paid? Are they going to renew the lease? Now, in some cases, if we can show that you're going to turn in the car and you're not going to lease another vehicle, in many cases we can do that with a letter of explanation or showing that you own another vehicle or both, then yes, we may be able to omit that, but that's in a case-by-case basis. Today, I just want to cover the basics and things that are generally going to fall as we discuss, right? We've got the installment debts with 10 or less payments remaining. That's in many cases we can omit that. Your medical collections, we don't have to count those against you. And your charge-offs. If on the credit report it's documented as a charge-off, then we also don't have to count that against you. Okay? Now, some things that you may not be counting or calculating in your debt to income ratio that we might have to count would be student loans, where you might have a student loan that's in a payment arrangement, or maybe you don't have payments for the next 11 months, right? So you're not calculating that in your DTI. An underwriter, however, is going to calculate that unless we can document that you will not have payments on that loan for the next 12 months or longer, guaranteed, okay? If we can't document that, then you want to calculate 0.5% of that balance in your student loan debt calculation. So for all your student loans, you would just want to take that balance, multiply it by 0.5%, and that will be the monthly payment that you include in your DTI calculations. I hope this helps. If you have any questions or you want to know exactly what your DTI or debt to income ratios are, feel free to reach out, comment below. You can always give us a call. I hope everybody has a great day.